Your tax code changed on August 5th. HMRC didn't write to you. They updated 5 rules that directly affect how much of your pension you actually keep. And 4 of those 5 changes mean you'll pay more from this tax year onward unless you act before October 31st. That's the answer. 5 rule changes, 4 of them costing you money, 1 deadline to fight back. Gerald Finch, 73, from Solihull, opened his September pension statement and noticed £218 less than the month before. No letter from HMRC, no notification on his personal tax account. Just less money. When he phoned the HMRC helpline and sat on hold for 2 hours and 14 minutes, the advisor told him his tax code had been automatically adjusted to reflect current legislative parameters. That phrase means nothing to a normal person. It means everything to your bank balance. What happened to Gerald is now happening to approximately 4.2 million UK pensioners who receive a combination of state pension and private or workplace pensions. HMRCs. August 2026 update changed 5 specific rules, and I'm going to walk you through every single one, tell you exactly how much each one costs, and show you the 3 forms that can reverse the damage before the window shuts. But here's what makes this particularly cruel. One of these 5 changes actually benefits you, and HMRC certainly won't be volunteering that information either. If you don't claim it by the deadline, you forfeit it permanently. I'll tell you which one it is later in this video once you understand why HMRC buried it alongside the other 4. Gerald's situation wasn't an error. His tax code moved from 1257L to 1192L overnight. That single change, 65 digits of difference in the code, translated to £1,308 less per year, reaching his bank account. Spread across 12 months, it felt like a slow leak. But it was a deliberate reallocation based on HMRC's new interpretation of how pension income interacts with the Frozen Personal Allowance. The specific mechanism sits inside HMRC's Internal Guidance Manual, PAYE 74030, updated without announcement on August 5, 2026. This manual instructs employers and pension providers how to apply real-time information adjustments when a pensioner receives income from multiple sources. The old version gave pension providers 30 days to reconcile codes with HMRC before applying changes. The new version allows immediate application, no reconciliation delay, no pensioner notification requirement. If you're over 65 and receiving any combination of state pension plus a workplace or personal pension, these 5 changes affect you directly. The cumulative cost, if all 5 apply to your situation, ranges from £1,900 to £4,600 per year, depending on your total pension income. Those figures come from calculating the impact across the standard income bands most UK pensioners fall into, between £12,570 and £50,270. Now, I promised you 5 rule changes, and I'm going to give you all 5. But I need you to understand the first one deeply, because it's the domino that triggers the other 4. Rule change number 1 is the automatic code adjustment I just described. PAYE 74030's removal of the 30-day reconciliation window. Before August 2026, if HMRC decided your tax code needed changing, your pension provider had to wait 30 days, during which you'd receive a coding notice in the postee, Form P2, explaining what changed and why. You could phone HMRC, dispute it, and have it reversed before a single penny left your pension differently. That 30-day buffer is gone. Your pension provider now receives the new code through RTI, real-time information, and applies it to your very next payment. Some pension providers pay monthly. Some pay every 4 weeks. Either way, by the time you notice the difference in your bank account, the new code has already been active for 1 full pay cycle. Getting a refund for that overpaid tax isn't impossible, but it requires filing Form P55 and waiting. Some tax professionals estimate 8 to 12 weeks for processing, though HMRC's official target is 30 days. Margaret Holloway, 69, from Cheltenham, discovered this the hard way. She'd been receiving £1,640 per month from her teacher's pension, plus her full new state pension of £221.20 per week. Her combined annual income sat at roughly £31,180. Comfortable, not extravagant. On August 19th, her pension provider applied a new code without waiting, without writing to her. Her September payment arrived £186 short. When Margaret phoned HMRC, she was told the code change was correct based on current information. But here's what the advisor didn't explain, and what most advisors won't explain unless you ask the exact right question. The code change was triggered because HMRC's system had re-estimated her state pension income for the year based on the April 2026 uprating, and it estimated £47 per year higher than her actual amount. That £47 discrepancy cascaded through the coding calculation and produced a code that overtaxed her by £186 per month. Not £47, £186. That multiplication effect is what catches people. A small estimation error at HMRC's end becomes a large deduction at your end because of how cumulative tax codes work across multiple income sources. Tax professionals in the UK are divided on whether this constitutes an error or simply the system working as designed. The answer likely depends on which HMRC office handles your file. The question Margaret should have asked, and the question you should ask if this happens to you, is this. Can you confirm the state pension figure your system is using to calculate my code? And does it match my actual annual state pension entitlement to the penny? Write that down. Say those exact words. Because if the figure they're using doesn't match your actual entitlement letter, the one you received in April, then your code is wrong, and they must correct it under Section 8 of the Taxes Management Act, 1970. Rule change number 2 hits anyone who took a pension lump sum, also called a pension commencement lump sum, between April 6th and August 5th, 2026. Previously, the tax-free element of this lump sum was entirely excluded from the coding calculation for the remainder of the tax year. You took your 25% tax-free, and HMRC's system ignored it when setting your code for the rest of the year. The August update changed this. HMRC's system now uses the gross lump sum withdrawal, including the tax-free portion, as a data point when estimating your total income for coding purposes. They don't tax the tax-free portion, but they use its existence to assume your overall income is higher, which pushes your code into a more aggressive collection position. Donald Whitmore, 67, from Stockport, took a £40,000 lump sum from his SIPP in June 2026. £10,000 of that was taxable. £30,000 was his tax-free allowance. Before August, HMRC coded him based on his actual taxable income, his state pension plus the £10,000 taxable portion. After August, the system saw the full £40,000 withdrawal and assumed his total annual income was £40,000 higher than reality. His code plummeted. His monthly private pension was suddenly being taxed as if he earned over £50,270 per year, meaning portions were taxed at 40%. Donald's accountant filed Form P55 and a separate letter under the PAYE regulations to request an in-year code correction. It took 9 weeks. During those 9 weeks, Donald overpaid £2,340 in tax. He'll get it back, eventually. But the cash flow damage was real. His direct debit for council tax bounced. His energy provider charged a £15 late payment fee. If you took any pension lump sum between April and August this year, check your tax code immediately. Log into your personal tax account on the gov.uk website. You'll need your government gateway credentials and look at the tax code for the current year section. If the estimated income figures include your full lump sum rather than just the taxable portion, HMRC has applied this new rule to your file. You'll need to phone them or submit an online query specifically requesting they remove the tax-free element from the income estimation. Rule change number 3 involves the marriage allowance transfer, and this one is genuinely baffling. The marriage allowance lets one spouse transfer £1,260 of their personal allowance to the other, saving the receiving spouse up to £252 per year. Simple enough. The transfer is supposed to remain active year after year until one spouse cancels it or the transferring spouse's income rises above the personal allowance. The August 2026 update introduced a new annual verification requirement. HMRC's system now checks at the start of each tax year whether the transferring spouse's income is still below the personal allowance. If the system cannot verify this, perhaps because the transferring spouse has no income reported through RTI, which is common for pensioners whose only income is state pension, the marriage allowance is automatically suspended until verification is provided. This is affecting thousands of couples where one spouse receives only the state pension and the other has a larger pension income. The state pension isn't reported through RTI, it's reported through a separate system. And HMRC's new verification check doesn't appear to cross-reference that separate system correctly. Some pension experts believe this is a technical oversight rather than deliberate policy, though HMRC has not confirmed either way. Janet and Raymond Pritchard, both 74, from Norwich, have used the marriage allowance since 2015. Janet's only income is her state pension of £11,502 per year, below the personal allowance. She transfers £1,260 to Raymond, saving them £252 annually. In August 2026, their marriage allowance was suspended without notification. Raymond's October pension payment reflected the loss of that transferred allowance, £21 less per month, small by itself. But compounding with the other changes, the Pritchards are now £3,100 worse off annually than they were in July. To reinstate the marriage allowance after a suspension, you don't simply phone and ask. You must reapply through Form MATCF, Marriage Allowance Transfer Claim Form, available online or by calling the Income Tax Helpline on 0300200300. The advisor can process it immediately, but the correction to your code takes up to 6 weeks to appear in your pension payments. I'd be curious to know, has your marriage allowance been affected by this? Because in the comments on recent videos, dozens of couples have mentioned their tax codes changed in August and September without any explanation letter arriving. If that's you, this is almost certainly the reason. Now, before I reveal rule changes 4 and 5, and remember, one of these 5 actually puts money back in your pocket, I need to address something about how all 3 of these first rules connect. Because individually, each one might cost you between £200 and £2,300 per year. Annoying, but survivable. Together, they create a compounding effect that HMRC's system doesn't self-correct. Here's what I mean. If Rule 1 gives you the wrong code based on an incorrect state pension estimate, and Rule 2 inflates your estimated income because of a lump sum you took 6 months ago, and Rule 3 suspends your marriage allowance because the system can't verify your spouse's status, all 3 happen inside the same tax code calculation simultaneously. They don't offset each other. They stack. Gerald Finch, the pensioner from Solihull, I mentioned at the start, was actually affected by all 3 at once. His £218 monthly loss wasn't from one rule change. It was from 3 of them layering on top of each other inside a single code adjustment. And when he phoned HMRC, the advisor only identified Rule 1. It took Gerald's accountant 3 separate calls to unravel all 3. If any of what I've just explained made you pause, and I suspect it did, Hitting the like button takes 1 second and it pushes this video toward other UK pensioners who are losing money this month without understanding why. HMRC won't explain it. The pension providers won't explain it. This might be the only explanation some people get before the October deadline passes. Right. Rule change number 4, and this one concerns anyone who has savings income alongside their pension. The savings nil rate band, that's the £1,000 of interest you can earn tax-free if you're a basic rate taxpayer, or £500 if you're a higher rate taxpayer, hasn't changed. But how HMRC accounts for it within your tax code has. Previously, HMRC assumed you would use your full savings nil rate band and code it accordingly. Your pension code would be set slightly lower to account for the fact that you'd pay no tax on the first £1,000 of savings interest. This created a small monthly benefit in your pension payments. Essentially, you were being underdeducted because HMRC assumed the savings interest would use up some of your tax liability instead. The August change removes this assumption. HMRC's system now codes your pension as if you have no savings interest at all, then reconciles at the end of the year through your tax return or through simple assessment. For pensioners with significant savings earning high interest, and with interest rates sitting at 4.75% in many easy access accounts right now, this means your monthly pension payments will be taxed more heavily throughout the year, and you'll receive a refund after April 2027. The cash flow effect is significant. Brian Hesketh, 71, from Lancaster, has £85,000 in premium bonds and savings accounts, earning approximately £4,000 per year in interest. Under the old coding, his pension tax code reflected £1,000 of that interest being nil rate, which gave him roughly £16.67 more per month in his pension. Under the new coding, he loses that monthly benefit and won't recover it until summer 2027 at the earliest, a full year of being out of pocket, with no interest paid on the overpaid tax. £16 a month sounds trivial. It isn't. Across 12 months, it's £200. Across 4.2 million affected pensioners, HMRC holds an estimated £840 million in overpaid tax for up to 12 months, interest-free. Some tax commentators have called this an interest-free loan from pensioners to the Treasury. HMRC describes it as improved accuracy in real-time coding. And now, rule change number 5. This is the one that benefits you. This is the one HMRC buried among the other 4, hoping you wouldn't notice. From August 5th, 2026, HMRC expanded eligibility for the blind person's allowance to include severe visual impairment that doesn't meet the traditional registration threshold. The allowance is worth £2,870 per year, meaning if you qualify, your personal allowance increases from £12,570 to £15,440. That translates to a tax saving of £574 per year for a basic rate taxpayer, or £1,148 for a higher rate taxpayer. The old rule required you to be registered as severely sight impaired with your local authority. The new rule, buried in Finance Act 2026, Section 14, Subsection 3, allows anyone who has been certified by a consultant ophthalmologist as having a corrected visual acuity of 6/24 or worse in their better eye to claim the allowance, even without full local authority registration. The certification letter from your eye consultant is sufficient. Dorothy Beaumont, 78, from Harrogate, has macular degeneration. Her corrected vision is 6/36 in her better eye. She was told years ago that she didn't qualify for the blind person's allowance because she hadn't completed the local authority registration process, a process involving a separate assessment, a waiting list, and considerable paperwork. Under the new rule, her consultant's letter alone qualifies her. That's £574 per year she's been missing, and she can backdate the claim by up to 4 years under self-assessment. Her potential total recovery is £2,296. If you or your spouse has any significant visual impairment, cataracts, macular degeneration, glaucoma, diabetic retinopathy, and you've been told you don't qualify for the blind person's allowance because you're not registered blind, check again. The threshold has expanded. You claim it by phoning HMRC on 030020033301 and asking to add the blind person's allowance to your tax code. You'll need your consultant's most recent letter confirming your visual acuity measurement. This is precisely the type of beneficial change that HMRC has no obligation to publicize individually. They updated the guidance on gov.uk, page tax-free allowances on your tax code, but they didn't write to the estimated 320,000 pensioners who might newly qualify. You have to know to look. I know this is dense. 5 rule changes, each with different forms, different phone numbers, different deadlines. It wasn't designed for clarity, and I don't think that's accidental. But if you've stayed with me this far, you're clearly someone who refuses to let bureaucratic complexity cost you money. Subscribing to this channel means you'll see the follow-up video I'm releasing on the October 31st deadline, specifically what to file and in what order, because the sequence matters, and getting it wrong means starting the process over from scratch. Most people tune out when tax coding gets technical. Don't. This next part is the piece that connects everything, and it's the reason some pensioners will recover every penny while others won't see a refund until 2028. Here's what nobody connects. Rules 1, 2, and 3 all manifest inside your single tax code, that K code or L code on your pension payslip. If you phone HMRC and dispute only one of the 3, they'll correct that one element and issue a new code. But the new code will still contain the errors from the other 2 rules. You must identify and dispute all applicable errors in a single call or in a single written correction using Form P87 or by writing to Pay As You Earn and Self-Assessment, HM Revenue and Customs, BX91AS. The specific phrase to use when you call is, "I'd like a full breakdown of all income sources and adjustments used in my current tax code calculation, and I'd like to verify each one against my actual entitlement figures." That sentence triggers what HMRC advisors internally call a full code review, and it's the only way to ensure all errors surface in one conversation rather than requiring 3 or 4 separate calls across multiple months. Gerald Finch, the pensioner whose story opened this video, eventually recovered his full £218 monthly overpayment. It took him until late September, one phone call with the exact wording his accountant gave him, and a Form P55 filed online through his personal tax account. His refund for the August and September overpayments arrived in mid-October. His corrected code took effect from his November pension payment. But Gerald had an accountant. Most pensioners don't. And HMRC's helpline, while staffed by people who are individually trying to help, operates within a system that only fixes what you specifically identify and challenge. They won't proactively scan your code for all 5 issues. You have to know what you're looking for. So here's your action list. Monday, log into your personal tax account on gov.uk and screenshot your current tax code and income breakdown. Tuesday, compare every income figure HMRC lists against your actual pension statements and your state pension entitlement letter from April. Wednesday, if any figure is wrong, phone 030020033300 and use the exact phrase I gave you. Thursday, if you or your spouse have visual impairment, phone 030020033301 to add the blind person's allowance. Friday, if your marriage allowance has been suspended, reapply through MATCF online. The deadline that matters most is October 31st, 2026. After that date, any code corrections you request won't be backdated to August. They'll only apply going forward. That means the tax overpaid between August and October becomes a year-end reconciliation issue, recoverable only through your 2026 to 27 tax return or simple assessment, which arrives in autumn 2027 at the earliest. 12 months of your money sitting in HMRC's account, not yours. 4 of these 5 rules cost you money silently. 1 gives you money if you claim it loudly. The system rewards attention and punishes assumption. Dorothy Beaumont filed her blind person's allowance claim on August 28th. Her code was updated within 3 weeks. She's now receiving £574 more per year than she was in July, and her backdated claim for the previous 4 years is being processed. She expects a lump refund of approximately £2,296 before Christmas. Gerald Finch has his correct code back. Janet and Raymond Pritchard reinstated their marriage allowance. Donald Whitmore received his £2,340 refund. Brian Hesketh is still waiting for his year-end reconciliation. He's considering filing a self-assessment return voluntarily to accelerate the process, though his accountant warns that once you enter self-assessment, extracting yourself is difficult. Every one of them only recovered their money because they knew what had changed and challenged it specifically. HMRC's system doesn't self-correct. It corrects when corrected. In the next video, I'm covering the October 31st deadline in full, exactly which forms to file, what order to file them in, and the 3 mistakes that cause HMRC to reject corrections and force you to start again. If you think these 5 rule changes were hidden, wait until you see what happens to pensioners who file their disputes incorrectly. That video arrives next week. Your pension isn't a gift from the government. It's money you already earned, already paid tax on, and already planned your life around. Don't let a silent code change rewrite the terms without your permission.